Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. U.S. President Donald Trump is increasing his threats against Iran. In a post on Truth Social, Trump warned that Iran's civilization will die tonight unless the country strikes a deal in what he called one of the most important moments in the history of the world. Trump is also demanding that Tehran reopen the Strait of Hormuz. The latest threat comes after U.S. forces struck military targets on Iran's main oil export terminal island, Card. Trump has set a deadline for a deal to be reached of 8 p.m. Eastern tonight. Home prices in Canada's largest city fell to their lowest level in more than 5 years. Data from the Toronto Regional Real Estate Board shows the benchmark price of a home in Toronto dropped 0.6% in March compared to the month before, the lowest since December 2020. Meanwhile, the supply of listings remained elevated. On the upside, the number of homes being sold in March increased for the first time in 6 months. Shares of health insurers like United Health, Humana, and CVS are getting a boost. And all this coming after the U.S. government announced it will pay private insurers close to 2.5% more in 2027. According to the Centers for Medicare and Medicaid Services, the policy is expected to add more than $13 billion U.S. in additional payments to Medicare Advantage plans next year. And taking a look at the markets now, let's see how they are doing. And you can see the TSX coming back a little bit from the start this morning. Still off, still in the red by about a quarter point. And south of the border, it is a similar situation. You can see the S&P 500 off by 0.37, the Dow down by about 0.45, and the Nasdaq's down. It's 0.55, but at one point it was down by about 1.5. So it has kind of clawed its way back, at least a little bit. Still in the red, of course, though. And the markets are navigating another volatile session as investors weigh a critical U.S. deadline for Iran, one that could send oil sharply higher or lower, depending on the outcome. We are looking at that and other market moves today with our next guest, Brian Mulberry, Chief Market Strategist at Zacks Investment Management. Brian, thanks very much for joining us.
Thank you.
Another day, another interesting day. Oil dominating the markets. Markets are focused on Iran. What are your thoughts on this? The deadline we have today, and where the markets might go, depending on I guess it depends on what happens with that deadline.
Yeah, I mean, the main story is escalation versus de-escalation. On the escalatory side, we don't have any type of peace treaty or, any type of concessions from Iran. And that means that this attack will likely go through this evening. And that could spike the price of oil beyond the recent close of $123.70 last week. And that means we could be well on our way up to something like $140, $150 a barrel, like what we saw during the Ukraine conflict a couple years ago. So that's really the concern if this thing does keep escalating higher and higher, is that the energy shock could continue. However, there's just as equal an outcome that we get some type of a peace agreement. That means that attack doesn't happen. We could see the price of oil fall, through, I think, a more like the $90 barrel point where we could see real deflation quickly based on just the flow of tanker traffic going through the Strait of Hormuz. We're getting a little bit better news there in terms of 20 to 30 ships a day, but that's well short of what the normal traffic pattern looks like. And so just getting the normalized flow of oil would actually be pretty deflationary pretty quickly. It just comes down to which direction this goes in the matter of a few hours.
Now, if these hostilities do continue through this 8 p.m. deadline, you mentioned $1.24. I wish $124 a barrel as a key level. What is so important about that?
That's the most recent high that we saw just in the last couple of weeks. And so that becomes kind of the level of resistance on a technical marker. If we break through that, that means the upside in the price per barrel could be really, really sharp, meaning perhaps another 15 to 20% higher from there. Again, that gets us to roughly 140. Whereas if we kind of stay below that key technical marker, it kind of contains a little bit of the inflationary pressure to where we are versus a more worst case scenario.
And all kind of bets are off is almost if we hit that 124 on where it may end up, and it's been inching up again today after a bit of calm. But and going the other way, talk about $90. Will we see a return back down to $60, or is that done?
I mean, the answer is likely yes, but that now gets moved to probably a year from now. There's going to have to be some normalcy in terms of trade, but also there's going to have to be investments made in restoring the infrastructure, mainly on the refining side, especially in the Gulf states. There's been attacks, especially on a couple of key critical facilities in the Gulf states, and they're going to need to come back online. So not necessarily crude prices, but on the refining side, we're going to need to see some more infrastructure repairs to get everything back to where it was before the conflict started.
All right, and we're starting to see that we're feeling these prices, obviously, when we fill up at the pumps, but also businesses are feeling it as well. Who's paying the biggest price, retail, wholesale, or in the end, will it be consumers, do you think?
Well, in the short term, it's definitely wholesale prices, and that's mainly driven by the fact that diesel is just so much more costly than regular unleaded at this point in time. And when you think about, just the global supply chain, the last mile of delivery of nearly everything happens on the bed of a diesel truck somewhere. So the input prices on the wholesale side are definitely being more impacted in the short term. If it continues on for another couple of months, in other words, if the price of oil is over 120 well into the summer months, then we'll start to see that come through in terms of cost increases on consumers as well.
All right, and I mean, in every crisis there is opportunity. What are you telling your investors? What are you doing here?
Well, the biggest hedge against this oil shock is to own the refining stocks. When you look at what's happened so far, you've seen Chevron, Exxon, Conoco, these types of really large refineries that have, footprints all across the globe. Their stock has done very well. So as oil has gone up 25, 30%, so has their stock price. It's just a hedge in terms of making sure that you have exposure to the asset that's increasing in value during this moment of shock. And so the good news for them long term is these refineries run at nearly 100% capacity, mainly because we haven't built any new refining capacity in the Western Hemisphere in the last 30 years. So even if oil does stay slightly higher than its long-term trend, they will continue to be more profitable as a result. So one of the biggest ways, again, just to protect your portfolio is to own space in the energy sector. And in particular, we like those refineries. All
right, and we're going to go in a bit of an opposite direction here. Universal Music Group and Bill Ackman's offer, a takeover, it's a pretty generous one.
Yeah, he's been a long-term shareholder in Universal Music for some time. He had built up to roughly a 10% position. I think he's let some of that go here recently. But, the properties and the artists that they work with, he just feels like they could add so much more value if they were to get that transitioned into a listing on a U.S. exchange, that the upside there for the stock price could be really tremendous. But also, it's just a very strong balance sheet. They feel like they could add to the dividend that would attract more institutional investors. So obviously a completely different kind of conversation than what we're having about the conflict, but a really good company that feels like they could just simply add a little bit more by getting it listed on a U.S. exchange.
And why has Universal hesitated? They're in the Netherlands. Why have they hesitated?
Well, I think it's just kind of more of a resistance to simply being on a U.S. exchange. I think there's been some activist shareholders kind of, butting heads on the backside. From the fundamental perspective, from a balance sheet perspective, I think Pershing Square has a lot to offer. So I'm not sure why they're resisting so hard.
And do you see this going through?
I think so. Yeah, I think this is a generous enough offer to make them really consider it. I think, it's kind of one of those moments in time where you're getting basically twice the value than what you are on the open market right now.
Okay, we're going to wrap it up there, Brian, but thanks very much for joining us.
Thank you.
Brian Mulberry is Chief Market Strategist at Zacks Investment Management. Coming up, fewer homes are coming to market, but buyers are still showing up. Toronto's housing is sending mixed signals. We'll break that down when we come back. Toronto's housing market is sending mixed signals right now. New listings continue to drop, tightening supply, while sales are holding steady compared to last March, a surprising sign of resilience. But the big question everyone is asking, have we hit the bottom? Here to break it all down is Tom Story, realtor at Royal LePage, Signature, and the Story team. Tom, thanks very much for joining us today.
Thanks for having me.
Okay, are we at the bottom? Let's get that one out of the way right now.
No, we're not at the bottom. The new listings being down on a year-over-year basis and the sales volume basically being the same is kind of like step one of the recovery, but this recovery is still going to take a lot of time. And for the general Toronto housing market, we have not bottomed out yet.
What's your big concern? What is telling you that?
You just look at the benchmark price over the last little bit, and even right now, technically the sale price went up from February to March, but that happens every single year, and we haven't seen proof yet that things have started trading sideways. And it's actually been interesting for the city of Toronto. You look back going 15, 20 years where we're either increasing in price or decreasing in price. It's very rare that we kind of have that flat line that we're hopefully looking for here. And we just don't have enough proof to call the bottom yet, other than maybe like some very specific pockets of the city under certain sale prices. But the general market just isn't quite there yet.
And the sideways, is that what you're talking about? Sale prices just kind of remaining consistent for a little bit?
Yeah, that's what we need to see. We need to see the new listings continuing to come down on a year-over-year basis, the sale prices being the same or slightly better, so the absorption's just higher than we've seen in previous years. And then eventually that, over a period of time, will probably start seeing prices go sideways and not going up and not going down. Because right now, for most property types, if you track over the last 18 months, they've just gone down kind of slowly every single month. And I think that confidence for buyers wanting to wait till they know they have certainty that they're going to stop going down is likely why the sales transactions have been lower as well.
And are there different within the market? I mean, is any section moving? And we know the condos have been taking a hit. Are they showing some signs of recovery? Or do they still have further to go?
I would call it like the end user condo. The floor plans that are selling right now that we're seeing in our own business are the 1+ dens over 600 square feet with parking spot. Parking has never been more important than it is today, with end users buying, not just investors. And your 2-bed, 2-bath over 800 square feet is moving at today's prices. But the condo market, it's representing almost 70% of the active listings in the city of Toronto. So we have a ton of condos for sale. The single family home market, specifically in east and west of downtown areas like Leslieville, the Beaches, Bloor West Village, the Junction, things like that, they're still extremely quickly moving and they're getting multiple offers, but it's mostly happening under that $1.5 million price point. So there's certain pockets that everybody wants to buy in with limited inventory, but for the entire market, we still have a lot to choose from.
And so is that people in those areas pricing to sell, or is it that those areas are places people want to be?
They're places that people want to be. We're finding that every single buyer that's upsizing, that has their first kid, and they're talking about neighborhoods they want to move to, they always start with one of these 5 or 6 neighborhoods. And then they realize that it's extremely competitive and sometimes change their search criteria. But those areas, they're still like the prices that you see over the sale price or over the asking price. Most of that is because they listed low. But that strategy only works when there's less to choose from and buyers are willing to play that game. So some markets are still pretty active right now, getting 10+ offers, but that's certainly not the story for the entire city. The rest of the city is more of a balanced out market pushing towards buyer's market in most categories.
And what's up there with the condos struggling? Is it the high end, or is it suburbs? People realize maybe they can get a better deal, be closer to work and closer to all the things going on in the city?
I think definitely those two factors, but also just like the condo market used to be 40 to 50% of the demand side of the market was investors. They're not participating in today's market like they used to. So I would say from what I'm seeing with my own listings and the buyers that are buying them, it's 95% an end user, someone that's going to buy it and move into it. And the condo market certainly hasn't bottomed out yet, so they want certainty and maybe built into that price for future downside. So that's really what's going on with condos. There's a lot of condos available, but only a certain percentage that end users actually want to buy.
And how much of a factor is the immigration changes and the actual population decline, I guess we saw in the last while? Is Toronto still the place people are coming to, or is it feeling it like other places in the country?
Yeah, it's certainly going to be a factor. We don't know exactly how it's going to play out yet, but I'll say the first thing that we're seeing is the rental prices have continued to decline. So you take into the fact that our immigration policies have changed significantly, and the fact that with the MLI Select program and the purpose-built rentals, we have a ton of new supply. So you're probably going to see good news for rental prices if you're a renter. They're going to be continuing to go down here. We haven't yet seen it increase in the sale side of things, but usually for new Canadians, they're not buying until about 5 years.
Okay. And the last one, interest rates. I mean, we were talking about it might be static for the year. Now there's talk it might go up, depending, of course, on what happens in the Middle East. At least the Bank of Canada rate, the impact of potential on mortgage rates. Is that a factor at all, or are people looking at the possibility now that we might see an increase and they're maybe moving in now to take advantage of a lower rate?
I think it's a huge factor. I think for a long time when they were going up and going down, buyers and sellers wanted to see what was going to happen before they made a decision. And with the certainty of rates holding, I thought that was going to be a good thing. Now we're going to see there's potential they could go up. We've already seen the fixed rates go up because of the bond yield just slightly, but they're over 4% now. I think all those factors put together and what you're trying to buy and what area of the market are definitely going to impact the sales volume that we see moving forward.
Okay, we got to wrap it up there. Tom, thanks very much for joining us.
Thanks so much for having me.
Tom Story is a realtor at Royal LePage Signature and the Story team. Coming up, we're watching shares of Broadcom after the tech giant locked in a new AI chip deal with Google and Anthropic. More on that and what it means for AI demand and the chip supply outlook when we come back. Well, the semiconductor space is back in focus with Broadcom's latest AI chip deals with Google and Anthropic, signaling long-term infrastructure spending that goes beyond GPUs. For more on what this means for AI demand and overall chip supply, we're joined by Pierre Ferragu, managing partner at New Street Research. Pierre, thank you very much for joining us.
Thanks for having me, Roger.
All right, let's talk first about the Broadcom deal. What does this mean?
Well, it means that, this insanely large build-out of the AI infrastructure that is probably going to exceed $1 trillion of spending this year already is not set to disappear or even to slow down, and will probably continue to grow. And what you see today is that Anthropic, Google, Meta, OpenAI, everybody in this industry are trying to secure as many chips as possible, as much power supply as possible over a very extended period of time until the end of the decade, probably. That's the scope of the contract that runs until 2031. And that's because all these players are seeing the pace at which agentic AI is actually getting adopted in the economy. And you probably saw yesterday, Anthropic announced they had reached a run rate revenue of $60 billion a year. And that's up from less than $10 billion like just a few months ago. So it's a level of growth, like a pace of growth at a scale that was never seen before. And the industry is basically planning out now almost like 5 years out in order to absorb this growth of AI.
Sorry, is it 60 billion or 30 billion for Anthropic?
Like the run rate they've announced, just Anthropic themselves, apologies for, is 30 billion. So if you add OpenAI and the rest of the market, that's about 60 billion.
Okay, sorry, I misunderstood.
For frontier AI, yes, absolutely.
With Anthropic, with that 1,000 business customers spending over $1 million a year, how important is that number, the 1,000 million numbers?
That's a good question, Roger. And I don't really like to look at it this way. This is the way a lot of companies look at it, in cybersecurity. All the very high growth software companies like to throw these kind of numbers. For the specifics of Anthropic today, the way I like to look at it is actually thinking about the number of developers you have. And we think there is about maybe 35 million developers on Earth today. And it's much better to think about it this way. So if you think a developer on average, if you take the average of the US developer and like the developer based in India or in China is $75,000 a year, we spend actually $2.5 to $3.5 trillion on software development a year. And that's really the addressable market for Anthropic. And the question is, how many developers are using Anthropic? And how much money do they spend each on Anthropic? Or, by the way, when I say Anthropic, I mean Anthropic or OpenAI or another one. And how far can that grow? And when you run this math, you realize that the $60 billion, so $30 billion for Anthropic and $60 billion for the overall, is actually still the very early innings of this development. Because if you assume we're spending, let's say, $3 trillion on software development today, in 5 years from now, probably we spend, $5 trillion, like 4.5 up to maybe $6 trillion on software development. And probably a large chunk of that incremental money we're going to spend on software development is going to be for token and not for human software developers, because human software developers are enhanced by token. And so that's the kind of metrics I look at. And if you look at it this way, $60 billion today, it's like, not less than 10% of the incremental spending on software development we are going to make in 2026. And it's only like a couple of percent of total spending on software development.
All right, now bigger picture with everything that's unfolding, we're seeing tighter supplies across CPUs, memory chips. What kind of an issue is that for continuing this pace?
So given the pace, given that end demand now is accelerating again, that's what Anthropic told us yesterday, and given that the supply chain has been already, running like pedal to metal for a couple of years already, this tells us that we're going to be capacity constrained for the foreseeable future. So we knew we were capacity constrained for memory chips, for GPUs, for manufacturing capacity at TSMC for 2026. Now we can safely say we are probably going to be capacity constrained probably until the end of the decade. And the reason for that simply is that there is so much, of course, capacity TSMC or Micron or others can add this year. And there will be so much capacity they can add next year and the year after next as well, because there are so many tool manufacturers like ASML and AMAT can manufacturing over that time frame. And at every step of the supply chain like that, you have between 2 and 5 years of lead times, like a very, very complex tool like an ASML EUV stepper. If you max out your production capacity, like building new factories that can manufacture these tools probably take, beginning to finish, between 3 and 5 years. So my guess is that we're going to have an industry that runs driven by capacity constraint until the end of the decade.
Okay, we have to wrap it up there, Pierre, but thank you very much for joining us.
Thank you, Roger.
Pierre Ferragu is managing partner at New Street Research. Coming up, health insurer stocks are higher today after a surprise Medicare Advantage rate boost. After the break, we'll dig into what this means for earnings and which names stand to benefit the most. The U.S. Energy Information Administration says fuel prices could keep rising for months even after the Strait of Hormuz reopens. The agency says despite President Trump's assurances that there will be immediate relief when the war ends, it is uncertain about the short-term energy outlook. It says the trajectory of fuel prices depends on a number of variables, including the duration of the Strait's closure and the amount of oil production that has been shut in the Middle East as a result. Boardwalk Real Estate Investment Trust has sold 4 properties for a total of $105 million as part of its capital allocation strategy. The trust also repurchased more than 1 million units for $66 million in the first quarter of 26. The Calgary-based company says its portfolio occupancy remains strong at 97% as of April. Billionaire investor Bill Ackman is proposing a $65 billion U.S. deal for Universal Music. His firm is pushing to combine the Netherlands-based music company with a U.S.-based acquisition vehicle. The pitch puts a 78% premium to Universal's last closing price. The deal would force through a U.S. listing that Universal has so far delayed. It is the world's largest music company and houses artists like Taylor Swift and Drake. Quick peek at the markets right now, and they continue to recover. They're still down, with the TSX now off by a little over a quarter point. And south of the border, yeah, they're still down as well, but a little better. S&P 500 off by 0.37, the Dow by 0.45, and the NASDAQ by 0.57. Health insurer stocks are surging today. Look at some of those numbers there. United Health up by 10%, more than 10%. Humana 8.7%, and CVS Health by 6.9% after Washington delivered a bigger than expected Medicare Advantage rate hike, easing margin fears and lifting earnings expectations almost overnight. For more on the immediate and long-term implications of the hike, let's bring in John Ransom, Managing Director at Raymond James. John, thanks very much for joining us.
Thanks for having me.
What do the investors like so much about this?
There's the micro and the macro. The micro is every 100 points of margin is 4% earnings for CVS, 7% for United, and 50% for Humana. So the big numbers. So the micro is margins are probably at least 100 basis points higher. And this is a business where you fight for every basis point. So that's huge. I think the macro is it signals that the government may be in a ceasefire in its 3-year war against the Medicare Advantage insurers.
Does this mean they've won? I mean, is this a huge money driver for them?
Yeah, Medicare Advantage for Humana is literally almost everything. For United, it's every 1 point of margin is $1.80 a share. So you think about, $17 of earnings this year. So every point on this basis is more than 10% of earnings. And for CVS, every 1 point is about 60 cents a share on a little over $7 of earnings. So yeah, these are big numbers. And when you have a 1% margin going to 2%, I mean, your earnings literally double. So these are very light margin businesses. In fact, 2 of the 3 insurers lose money. In MA, United makes about a 1% margin. So we're just in this multi-year clawback to getting something more normalized. More normalized looks like 2, 3, 4% margins versus negative to 1 today.
And now you mentioned Humana's almost 100% in there. Are they the winners then out of this? Or it sounds like they're all winners right now, but are they the biggest winners?
So it's a little complicated. Humana has got the biggest exposure, but the problem they have is they lost their star ratings, and they have huge growth this year because they promised the most generous benefits. So while it affects the Humana the most, there's still more questions about Humana with its star rating disadvantage against its 2 big competitors, as well as, what does the growth portend in terms of their margins this year?
So does this make everything perfect and happy, and there's no other problems? They've all gone away now? What legitimate concern?
United Healthcare was supposed to earn over $30 a share. So this year the earnings are 17 and change. So you can see the hole they dug themselves. So we are looking for them to get back into the mid-20s from an earnings trajectory standpoint by 2028. And our estimates are 7-8% above the street. And if you look at the 28 numbers, there's a huge divergence of opinion about where they're going to be, anywhere from $21 a share to $29 a share from some of my peers. So no, this is just sort of either the beginning of the end or the end of the beginning of the recovery.
All right, you're saying 7 to 8% above the street is what you're thinking. What gives you that confidence, and what do they have to do to get there?
So we've got their Medicare Advantage margins improving only about 0.5% a year. So I think with this rate update, that's going to be pretty doable next year. This year, they priced for a 10% trend. I think that might end up being conservative. So we feel good about the visibility this year, next year. Now, longer term, and this is a very important point, is their SG&A ratio is almost 13% of sales. I think they have a long-term target. They've not said this exactly, but we've heard some secondhand comments that their goal is to cut that in half. So if you were to cut every point of SG&A is $3.50 of earnings. So in this perfect world, if they were to cut from, say, 12.7 to 8, you're talking about another $25 a share of earnings on a base today of $17. So there's an AI angle and a G&A angle in addition to the Medicare recovery. It's just they've not given a formal target for when SG&A is going to be at what point by what year. But we think there's a huge opportunity. I saw yesterday that insurance claims processing is the number one or number two use of AI across all industries. So there's plenty of opportunity for them to look at their manual processes as well as all these acquisitions they've done and not integrated.
Yeah, it seems. Sorry, go ahead.
That's the story. The AI really is the story now that we've got Medicare a little more in the rearview mirror for the next couple of years.
I was going to say, and it seems like the health industry is one of the ones that really is looking to benefit from AI.
Yes, very much so.
And so what are sorry, go ahead.
Now this year they're spending $1.5 billion and only saving $1 billion. So the lines haven't crossed, and we don't have any long-term visibility from the company about when those lines cross. But the opportunity is pretty astounding. Like I said, we've only got SG&A improving 20 bips a year for the next 2 years. So we're still above the street with a very, very modest SG&A improvement. But again, we're flying a little bit blind until the company lays out more concrete targets.
And this isn't
and to be fair, we upgraded the stock April Fool's Day. People thought we were crazy to get in front of the rate notice, so we got lucky there. But our thesis was we thought the rate notice would get better than people thought for a bunch of reasons, number one. But number two, we think people were missing the long-term AI/SG&A opportunity.
All right. What potential headwinds could there be? Because this has been an industry that has been pummeled a little bit, actually more than a little bit.
Oh, for sure.
What other headwinds could they be facing?
Yeah, so United in 2022 traded at a premium to the S&P. About 15%, I think, was the all-time high watermark when things were good. Right now, we've got them trading at a low double-digit multiple in our 28. So they're well under. They're the biggest discount relative to the S&P in my term of covering the company since 2018. So look, what could go right is medical trend could be better than expected. Future rate notices could be better than expected, and SG&A cuts could be better than expected. And then what could go wrong is the opposite of all those things.
All right, well, we'll wrap it up there, John, but thanks very much for joining us.
You're welcome.
John Ransom is Managing Director at Raymond James. Coming up, are we looking at $200 oil if Trump follows through on his threat on Iran if a deal isn't made by 8 p.m. tonight? More on that after this. U.S. President Donald Trump threatened to wipe out Iran if it doesn't make a deal by 8 p.m. tonight, as top Democrat and Senate Minority Leader Chuck Schumer called him an extremely sick person. With oil prices on the cusp of exploding, is Canada in a position to benefit? We discussed this earlier with Clay Sagal, Senior Fellow at the Energy Security and Climate Change Program, Center for Strategic and International Studies.
I think that the brinksmanship is certainly at an all-time high since this war started in late February. But the stakes are really high for the energy market in particular, and from that, the global economy. Because if we have a sustained period of very high oil prices, that's going to proliferate through other parts of the macroeconomy. Consumers are going to have to pay more, and they're going to be less likely to spend on other stuff. Businesses are going to have to pay more to move goods from factory and port to market and to people's doorstep for substantially everything that households buy. So we're going to see higher prices proliferate through the economy, and that could result in an economic slowdown, GDP coming in lower than forecasted before the war, and potentially even a rise in general price inflation. But in the energy market in particular, we have to be concerned about demand destruction, or at least demand curtailment. And so even for oil producers that tend to do better along with somewhat higher prices, you can have too much of a good thing. And we've seen in past oil price spike episodes that prices got so high that consumers and businesses pulled back on demand. And that's not good for oil companies either. They prefer a steady state of sustainable prices for the medium and long term.
It's kind of not bad for the environment and other things. I mean, there could be some positives when it comes to that. How, with these soaring prices, are we talking recession if it continues, if this deadline comes and and the end of the world is launched on Iran, is what as Trump was threatening. Will that lead to a recession if this war drags on?
The end of the world, as you put it, does sound bearish for financials generally. But I would say away from today's tactical deadline, and who knows what's going to be in effect by this time tomorrow, the bigger picture here that companies need to plan for is medium-term instability for energy exports from the Gulf. We were receiving about 15 million barrels per day to world markets of crude oil from the Mideast Gulf before the war, and that's down to just about 6 million barrels per day. So we've lost 9, we've lost 60% of what was coming before. And the world oil market can't live, at least at the same size as before, without that flow of oil from the Gulf. And gas is important too. So 10 billion cubic feet of liquefied natural gas, primarily from Qatar, some of which is going to be offline, apparently, according to Qatar Energy, for a period of years. Where I'm going with all this is the world market needs that supply from the Gulf. There's no way that supply-side adjustments can compensate for that size outage. And so the only coping mechanism for the market is to shrink if we have sustained high oil prices, and that's going to mean a downturn in demand. And that's what translates to the lower GDP that I was alluding to before.
And now we're seeing it, of course, in Asia. They're having to pull back. They're rationing. Europe could be next. Could that come to North America? I know we're considered an oil country in Canada and an oil exporter in the U.S. Could it come to us, though, as well? Could it hit us?
Yeah, certainly it will hit us in some capacity. It's true that here in North America, we are somewhat indemnified from the global effects because, of course, we are long crude oil. And in the case of the United States, at least, refined products. We're exporters to the world. But it's a global commodity and a largely fungible commodity. And that means that a disruption anywhere affects prices everywhere. And you've already seen headlines as recently as this morning that North American crude oil prices are starting to get pulled higher, even though there's no sign of a physical shortage in this part of the world yet. That's just simple global arbitrage. When you start to get higher prices in Asia, that's going to pull more crude oil from west, like in the Atlantic Basin, toward those east of Suez markets. This is how efficient markets function, and we're seeing it again in the case of this disruption. This
adjustment, how can you see Canada benefiting from this, or will they?
Well, when we talk about benefit, you have to think about the time horizon. And the way these price spikes have gone in the past is, of course, higher oil prices, which is the product that producers sell, can be beneficial for earnings in the short term. But if the secondary effect is for a pullback in demand and potentially even permanent demand destruction in some cases, and I think you alluded to the environment and maybe potentially the sale of additional electric vehicles, and in other words, some segment of the transportation industry retiring conventional engines and switching to renewables, that has the potential for longer-term effects to have lower prices. We have to see how all this shakes out for regional balances before we can really call prices, though.
And could this drive the electric vehicle market? I mean, we've seen the rebates and everything disappear in a lot of places, but the 73 oil shock drove a lot of people towards smaller cars. Could this be a tipping point for electric vehicles as well?
Yeah, I think it's definitely possible. If you run something like 6 to 12 months of really elevated gasoline prices, I do think that that's constructive for the EV sales trajectory. But longer term, when we talk about effects on the environment, I mean, you can say that it all adds up, and I think that that's true, even on an incremental basis. But you got to remember, it takes many, many years, even more than a decade, to put a significant dent in the stock, the composition of the vehicle fleet that's out on the road. And so even if you had a change in new sale patterns over a period of 6, 12 months, that's probably not enough uptake into the stock of the total fleet that's out there on the roads to really make that big of a difference, moving the needle for greenhouse gas emissions and environmental consequences.
That was Clay Seigel, Senior Fellow at the Energy, Security, and Climate Change Program at the Center for Strategic and International Studies. Still ahead, today's Market Movers with Bloomberg's Matthew Griffin. right, for some movers south of the border, we are joined by Bloomberg Equities reporter Matthew Griffin. Matthew, thanks as always for joining us, sir.
Thanks for having me, Roger.
Okay, this can't bode well when an energy company takes a big hit during the middle of an oil crisis. Phillips 66, what happened?
Yes, well, Phillips 66 said yesterday that they expect a $900 million blow to their results in the first quarter from short positions in oil, refined products, related commodities. And you're right, this is a bit of a counterintuitive story to see during a conflict that has sent oil prices surging, shares of companies in the energy sector surging, got this stock down about 1.5% today, with U.S. energy stocks broadly in the green. That said, if you think about it, this is exactly why the company has these positions. They have pretty significant exposure to commodity prices, and they hedge that exposure through this kind of contract so that their earnings don't swing too much when we have these really sharp price spikes. They're really hedging against downside here. Now, analysts are saying this may be more of a timing issue. UBS saying they expect a really strong second quarter for this company. They're an oil refiner. You are going to see, price increases, margin increases for a lot of their products. That being said, what you're seeing right now is the blow to these paper positions. That's what shows up first. Of course, stock's still up about 35% year to date, so doing just fine in the current macro environment.
And so does it have any more possible hits lined up, or is this the big one?
That's something that analysts have not weighed in on. Now, one assumes that the company is going to keep hedging exposure. I think it really will depend on the direction that the commodities go from here. And that's, anyone's guess, as we've all been talking about this week and for the last month or so.
And do we know any other companies maybe looking at something like this as well?
I would, again, we haven't really seen companies detail it much, so I would hesitate to name specific names, but I do think investors are going to be watching broadly across the space. You and I have talked a lot about airlines. The interesting thing there, they do, in the U.S. do not hedge their fuel exposure. A lot of them used to. They suffered losses like this during the financial crisis on hedged positions, and that actually made them stop hedging. We can see this kind of volatility.
All right. Well, let's see what happens with that. Tractor Supply, TSC, right, is what they go by, is it not? I mean, if it's the same company, I used to love going into that store. What's going on with them? I've actually never been to one. It's Tractor Supply on the website, although I don't have it in front of me, so I hesitate to be definitive. But yes, this, Roger, I picked these stocks based on the interesting moves, but a lot of it comes back to the war in Iran. You had Bank of America today saying that demand for this company's products is uncertain due to the conflict, due to the spike in gas prices. They sell, yes, tractor parts, but also, anything that someone who lives in a rural area might need, landscaping tools, horse feed, chicken coops, all sorts of products like that. And a lot of them fall into a discretionary category. You were just talking in that last segment about the idea of these second order effects that you can get demand destruction for energy when prices rise. You can also get lower demand for a whole bunch of other products as consumers cut back on their spending. And that's what Bank of America is concerned will happen here. They restarted coverage of the stock with a neutral rating and with the lowest price target on Wall Street in Bloomberg's data. And they also said that this company was facing headwinds in its discretionary spending from consumers before this even started. So, this just piling on more pain here or threatening to. All right, I'm just looking. They got their chick days coming up on their website. So if you want to catch any eggs, Matthew, there you go. Go to TSC. All right. Thank you, sir, for joining us today. I really went off on a tangent on that one there.
No, thanks for having me. Yeah, they sell, they say on their website, they sell everything but tractors.
All right, well, we got to leave it there. Matthew, thank you as always, sir.
Thanks for having me.
Bloomberg's Matthew Griffin. Know Your Options is coming back. Tune in tomorrow at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. And that wraps up this edition of Trading Day. I'm Roger Peterson. Thanks very much for joining us. Have yourself a great afternoon.